I wouldn't characterize the state of the economy as booming, but I wouldn't characterize it as slumping either. I don't think that there's been much change in what has been a relatively stable period of moderate overall expansion. That does not necessarily translate into a general feeling of well-being, and that's the disconnect between the claim that's based upon the overall economic statistics and the political effect of that claim, as the previous administration discovered. The great slump with which they took office was resolved, and there was a continued period of expansion, but they were nevertheless turned down at the last election. Generally speaking, the American economy has suffered a massive deficit in its in the construction and maintenance of basic infrastructure. So there's a lot in this country that is no longer at the peak of modernity, if you like, and the peak of good maintenance. You can see this just about everywhere. And the efforts of the previous administration to remedy that problem, bipartisan infrastructure law and so forth, were, I think, not terribly well directed because they were diffused out over the whole country in such a way that the priorities were largely those of the local governments. So there is still a great deal that would need to be done, and for which there really isn't the capacity. So that you have a general sense that the standard of living is not improving, particularly in the public sphere, as well as people would like. The fact of the matter is that so long as people are willing to hold United States Treasury bonds and bills, and so long as the interest rates are effectively under the control of the U.S. Central Bank, then the public debt just simply is what it is. It's not. It is not a constraint on the policies of the United States. So that's a question in which, as I say, economists and others tell stories about this, but there's very little evidence that those stories are in fact correct. Now, there are larger geopolitical questions. How much does the rest of the world want to continue to hold U.S. dollar-denominated instruments, and that will affect the value of the dollar over time. But even that's a mixed blessing, or let's say a mixed. The effect of that is mixed, because while a lower dollar means more expensive imports for American consumers, it also helps to restore the competitive position of what remains of American industry. So one can argue that position one way or back and forth one way or another. I've mentioned three separate policies: fiscal, monetary, and industrial. Monetary policy is certainly the easiest one to change in the short run. Administrations and putting pressure on the Federal Reserve to lower interest rates. I happen to sympathize with that position. I think the Federal Reserve's notion that it can raise the interest rate to bring down the inflation rate and lower it and so forth is really a position that no longer is supported in the structure of the economy and by the evidence if in fact, well, at a certain point it probably was, but I think the conditions have changed in such a way that it's no longer a very powerful force, and the effect of the high interest rate policy, which was put in place in 2022, has been to very seriously affect the housing market, which is a significant thing, but not the single driving force behind either the economy or the inflation rate. I think on the whole, a lower interest rate environment accompanied by anti-speculative regulation would be a better policy mix. That's not necessarily what you would get from this administration, but that would be the way I would pursue matters. On fiscal policy, the fact is that the strong presence of a push from fiscal policy, I would say, the large deficits that we've tolerated for a long period of time have been essential keeping the American economy growing. Without that, you would have been in a much worse position. Industrial policy, well, previous administration's industrial policy was one which relied heavily on tax incentives and to some degree subsidies. And these are very hard for the Americans. First of all, the tax incentives leave the decision making in private hands. And the other arm of a policy, which would be a state-directed policy, is one for which the United States government has had its capacity largely reduced over the last 50 years. It's very hard to implement in a successful way. And we've seen this essentially. There have been some results, but they're not very impressive. This administration, of course, is trying to do this, achieve some of the same results with a tariff strategy. And that's a tool with some power. It will have the effect, it is having the effect of encouraging firms, for example, European industrial corporations, to locate new facilities in the United States, something which is also encouraged by relative energy prices and other things. But it's that too is a strategy which would require a sense that the policy will be maintained for a long period of time, and in spite of its effects on the cost of living in the United States. And if you're a private business, you can't be sure of that. So you have, I think, in each of these cases, rather limited capacity to achieve the notional goal, which is a large-scale reindustrialization and of the country, and undoing the effect of, let's say, 50 years of globalizing neoliberalism. Just has been the case since the Reagan period, effectively. Well, we shall wait and see, but I'm not terribly optimistic. We have been locked in to a pattern which has made raising and maintaining the basic living standards in this country. And again, I'm talking about the public infrastructure and the management systems and so on, and quality of employment. Very difficult, so that a very large share of the employment, in fact, practically all of the employment that's been created in this country in the last 40 or 50 years has been in the services sector, not in manufacturing. A lot of it in healthcare, for example. And this is a world in which let's just say, the expectations that families of my generation had of having stable employment and steadily rising living standards, very difficult to meet. People feel a sense of precarity. They feel a sense of stasis. That was not the case for people like myself who can remember certain periods in the past. And reversing that sentiment would require a very major change in the nature of the economy, which I really rather doubt will be. I regard the problem of inequality, or the issue of inequality in this country, as being primarily a artifact or consequence of the structural changes in the economy over the period we've been discussing. And in particular, you can say that the United States was a very strongly middle-class industrial democracy 50, 60 years ago, where and even a little longer, at the end of the Second World War, about 1/3 of the labor force was unionized. It was an industrial labor force. It obviously had advantages that stem from the fact that the U.S. position in the world was untouched by the war and in fact, strengthened by it. And this position has been, this situation has been in, a period, let's say, a very long-term structural change, which was accelerated in the beginning of the late 1970s through the 1980s and 1990s and beyond by, let's just say, globalization, deindustrialization, and the rise of an economy whose strong points were basically on the two coasts. You had finance, insurance, real estate, headquartered on the East Coast, technology, aviation, information technology, military technologies on the West Coast, and in between, a large area of regions that lag behind. And this, of course, reflected in the politics of the country. The two coasts are primarily oriented toward the Democratic Party, the center of the country toward the Republican. And you see this effect on the distribution of income. We did an exercise with my little research group some years ago and showed that if you take the inequalities measured across the counties of the United States, and the country's divided up into 3,150 counties, so it's a small geographic unit, you could, in the 1990s, basically isolate one half of the increase of inequality to 5 counties. They were New York, which is the headquarters of the financial districts of Wall Street, and 3 counties of Northern California, which is to say Silicon Valley, 1 county in the state of Washington, which is to say the headquarters of Microsoft. So you're looking at that where the really very high incomes were concentrated in very, very small parts of the country. And later research, which we're still ongoing, really confirms that basic picture that very, very wealthy people whose incomes drive the overall measures of inequality and drive the power structure are concentrated in very small parts of a very large country. Not entirely unlike the Chinese situation in the early years of the reform period, by the way, in which you had massive increases in incomes in Guangdong province in Shanghai and Beijing, which were driving inequalities in the whole country, which then became modified by the more rapid growth in other parts of the country, and particularly the large eastern provinces. Yeah, China succeeded in diversifying its economic base over this period, and again, it started in a few places and then spread out to a larger number. And this has an overall, initially there's a very large increase in inequality, and then it tends to be moderated by the diffusion process. And we have not yet seen, and have not seen in the United States, a similar diffusion of the economic gains that were registered, and they won't, because finance is necessarily a highly concentrated activity unless you take really extraordinary steps to break it up, and information technology likewise is a matter of relatively small corporations who control vast sectors of this dimension of the economy and concentrate an enormous share of the rents and profits associated with the whole economy in their own hands. So this is why a company like NVIDIA, and it's not the first one, Alphabet and so forth, have such extraordinary market valuations, when in fact they're not all that large. As companies go, they don't have anything like the workforces that a major automobile firm, for example, is going to have. Why this particular pattern was allowed to develop? I think the answer to that is that the decision making was taken by through the capital markets, not through the government. And what effectively happened, and this is going back into the history of, let's say, the information technology sector, was that a scientific establishment that was previously within the government or in the large laboratories of large industrial corporations. AT&T's Bell Labs was a classic example in the transistor and the semiconductor here. Were essentially spun off into separate corporations, which could be capitalized separately. And they then succeeded in basically capturing the rents from the whole industrial process. So that, for example, I mean, again, another piece of history, when IBM was moving toward small computers, such as we now use, it basically devolved the software systems to Microsoft. And that's a separate company. And it turned out that you could extract all of the capital value from the larger companies by controlling the software systems. And this then meant that Microsoft became a very highly capitalized company, and International Business Machines, IBM, became a substantially historical artifact. So you see this all through this process, which is concentrated uh, the capital value and therefore political power in the hands of a small number of people who now are very closely associated with public power in this country. They were initially part of the Democratic coalition, but they've gone over to Mr. Trump in the most recent cycle, and you can see them all present at his inauguration, and in the case of Mr. Musk, heavily present in the first months of his administration. Of the view that decoupling is really, strictly speaking, uh, not very possible. That the two economies are, in fact, have the interdependence is really quite deep. That said, it has been a view of American political authority, and not just this administration. So the previous one has been for some time, that the U.S. dependency on China in key technologies and key materials and so on is a security risk for the United States. A whole range of things that people are concerned about, from the let's say the information sharing, but also the dependency on magnets and rare earths, so the things one hears about all the time. That they ought to make the effort to make the U.S. less dependent, give it autonomous capability in these areas. That's very difficult. The efforts to achieve this are really, I think, at this stage, have a very uncertain prospect. Let's just put it that way. They 4 or 5 years ago, the White House issued the Biden White House issued a very thorough study, which I reviewed, on the questions of supply chain dependency. And then, they made the point that we don't really have training programs for miners in this country. Why not? Because the schools of mines closed down because there weren't any mines that would provide jobs. Well, if you can't prepare a mining industry, it's very difficult to reopen, mines. So, for this reason, you end up relying on a country which has maintained and developed that capability. Now, that says that if you're going to restart the business of own sourcing scarce minerals, first of all, you have to find them, and secondly, you'll have to have a whole infrastructure of trained people and equipment that you gave up some time ago because you didn't need it, and it wasn't competitive anymore in world markets. And then if you do build it, you're going to be working with a sector which has a higher level of cost than the rest of the world is working with. And we see this, essentially in every aspect of the relationship. The electric vehicles is just another clear-cut example. The United States does produce electric vehicles, but you can acquire a Chinese-made one, and apparently quite good quality for a fraction of the price that you pay for one here. And so this, again, is a situation which is you can work on providing, the U.S. has a big internal market, and you can certainly work on making it more autonomous, but you're paying a significant price when you do. First of all, I think that the goals of sanctions with respect to China and with respect to Russia are quite different. I don't see that any plausible advocate of restricting trade with China thinks that it's going to derail the Chinese growth model. It's not a plausible theory. It was and it has been and still is the view of the architects of the sanction policy that they could bring really very strong pressure and effective pressure to bear on the Russian Federation. That's certainly what the strategy was. And in fact, in the early part of after the escalations in 2022, we were being told that the Russian economy was being brought to its knees and it would soon be crawling back to negotiate terms because of the sanctions policy. And this, of course, didn't happen. And I wrote on this actually already 2 years ago to explain that you have two possible explanations for this. One is that the sanctions didn't work and that they were effectively evaded. And that explanation fails, because if the sanctions had been ineffective, if they hadn't had any effect on the Russian economy, nothing would have happened, nothing would have changed. And in fact, things changed in a very dramatic way inside Russia, and Russian sources confirm this. On the facts, the two sides are not very different. They show that the sanctions had a very large scale. The word the Russian Academy of Science used, a large-scale crisis effect on every sector of the Russian economy. But what was that? That's the question. And the answer was, well, it forced foreign firms to leave the Russian market. It imposed what were effectively capital controls, which China has always maintained. It made a necessary to in-source components to accelerate the process of import substitution against machinery and so forth that was being imported from Germany, from Japan, and elsewhere. It slowed Russian export of raw materials, of resources, of energy, which meant that the prices internally were very stable. And all of that meant that the conditions for the growth of the Russian economy on a more autonomous basis were very favorable in ways which would not have been the case if the sanctions hadn't been imposed. Russia had a government, its economic policy had a strong, let's call it, open neoliberal component. Russian top businessmen, oligarchs, if you like, were highly mobile between Russia and the West. And all of this came to an end. And the effect of that on the Russian economy was very favorable for the growth of Russian manufacturing capacity and even agricultural and other capacities that had been fallow, had been neglected for a period since the late 1980s, effectively. And so there we are. The sanctions. I characterize the sanctions policy toward it, in a sense that it imposed conditions on the Russian government, which the Russian government would not have taken on their own. And those conditions actually favored the strengthening of the Russian economy. Now, I certainly do think that let's call it, if you want to talk the global economy at the global scale, that we have moved already toward a multipolar systems and fashionable BRICS. And let's ask what that means. What was it before? In the Cold War, it was substantially a bipolar system. You had the West and the East, and well, the East had a Chinese element to it. To be frank, the Chinese element was not very influential in the wider world. It was, in a period of Chinese autarky and post-revolutionary developments, if you want to call them that. It was the USSR and the United States as the two poles of the Cold War system, which was a fairly stable system. It fell apart. And from the 1990s onward, there was a strong sense, certainly in this country, that the world was one that needed to be organized around a single pole, unipolar hegemony, and a unipolar hegemony with a single economic doctrine, which is to say global neoliberalism, free trade, free capital flows, with the decisions taken largely, in New York and London and other financial capitals as to who would get the resources to pursue development strategies and who would not. And that was, accompanied by a lot of notions about what kind of political systems would result. Essentially, one in which the world would be integrated around a single financial regime. China did not choose to go along with that. And I have to say, I had a position as a technical advisor. My title was Chief Technical Advisor to for macroeconomic reform and strengthening institutions to the State Planning Commission in China under a UNDP project from 1993 to 1997. And this issue was under discussion at the time. I was not really in any significant way part of the Chinese decision-making process, but I did bring in people whose views I respected to provide their view on it. And our view was very strongly that China needed to maintain its own autonomy and its own capital controls, which they did. They didn't liberalize in 1995. They weren't affected by the crisis in 1997. And the effect of that, I think, was a strong contribution to China being able to maintain a trajectory of strong domestically centered economic expansion, technical development, infrastructure development, the whole thing that we've seen over the subsequent almost 30 years now. So there we are. This then meant that there would not be unipolarity, that the world would have to operate on several different bases, which is more normal and which is more likely, I think, to be stable once everybody gets used to it. The problem that we have in the United States is a whole generation of leadership grew up thinking that the U.S. was in a kind of singularly privileged position, not a normal country, but with major responsibilities and privileges. And that world is slipping away, has slipped away. It's no longer exists. And the people who hold that view they will also slip away in the end, and will have to be essentially succeeded by people who understand that the world is a world of multiple polarities. Now, what's interesting about some of the political organizations that we're now seeing, BRICS, for example, to my mind, is that there's no single ideology there. You don't have, unlike the cold ideology, capitalism, communism, and so forth, where you have two sets of ideas with specific, let's say, intellectual and ideological leadership. This is not the case now. If you look at Brazil, Russia, India, China, South Africa, they're all very different. They all have their own intellectual traditions, some of them influenced from the West, some of them with other sources of influence. And this is going to be, I think, I will say it's entirely novel because the United Nations system was built on that idea, tended to be built on that idea. But it is a very big departure from the world of not just American unipolarity, but the unipolar dominance of what I'll call neoclassical neoliberal economics. The idea of that the traditions in economic analysis, which are now academically dominant in the United States and other countries, are the ones which are going to determine the future of the world. This is not going to be the case. I'm inclined to think that shifting the basis of the world's reserve system is going to be a fairly slow process, if it happens at all. It's one thing, and of course, in response to the sanctions and other threats, countries are moving towards settling their trade bilateral trade balances in their own currencies, which is fine. But so long as those those exchanges are relatively balanced, that's self-liquidating. Where you have a buildup of surpluses on one side, deficits on the other, which is the position of the U.S. with respect to the rest of the world, then the U.S. is going to be issuing debt. Someone's going to hold it. Question is at what price? And it's rather difficult to get away from that system because you have to have an alternative that is stable. Gold, traditional alternative, not terribly stable. It's rising like a shot at the moment, but that doesn't mean it will always continue to be. And anybody who bets on that is not necessarily going to end up a winner. Cryptocurrency, I don't think so. No, what do I know? Some combination of everybody else's currency. Well, then the question is what combination? Now, with the U.S. Treasury market, you have something which is very stable, very liquid, very large, and so it's relatively easy to make that into the medium, and that's a very mixed blessing for the United States. On the one hand, it does mean that U.S. consumers have become heavily reliant on imports, enjoy that element of their living standard. On the other hand, it means that U.S. industry, which has to sell on world markets, good luck. Everything's overpriced. Wages are too high. And resource costs are too high, and so on and so forth. And you can build factories to sell into the North American market, U.S. and Canada, but to sell from the U.S. to the rest of the world, well, aside from some particular products that have traditionally been strongly rooted in the U.S. commercial aircraft, for example, it's hard to see how you get a broad-based, globally competitive industrial revival with when you're also providing a highly valued financial asset. And that then again is an internal problem for the United States because the rents from the financial activities are concentrated in the hands of a small number of people. So you end up with a very unbalanced domestic economy. Well, this gets into the subject of my latest book, which is co-authored with a mathematician originally from China, Jing Chen, which deals with the question of economic theory. And what happened really in the course of my professional lifetime, my last 40, 50 years, was the complete takeover of academic economics by a framework oriented toward perfect competition, general equilibrium, perfect information. Essentially, the dominance of market mechanisms in an economy centered on exchange mechanisms. And from that, everything else sort of follows. And Uh, the reality of the world is that the economic problem is a problem primarily of production, not exchange. If you don't produce anything, you don't have anything to exchange. And so the decision to produce is what you need to have an analytical framework for. And that decision is necessarily one in which you are dealing with uncertainty. You're dealing with the need to make fixed investments in order to extract resources. The whole conditions of real world existence come into play. And in particular, you're thrown into a world where you can't isolate yourself conceptually from the scientific understanding of the last 150 years, which is rooted in, among particularly the second law of thermodynamics, that the whole processes whereby energy is used and used up and waste products and so forth are generated. So what we did in our little book, Entropy Economics, was to present a framework for thinking about those issues, thinking about production in its time-dependent uncertainty, so forth, resource-dependent context. And we find that really very intellectually rewarding, profitable, enables you to have a relatively straightforward theoretical basis for considering the problems of the real world. And it's not something which is new or unusual. Engineers, physicists, but also at the scientific level, but at the practical level, engineers operate obviously with this all the time. Otherwise, nothing would, but technical accomplishments would be possible. It's only academic economics, which has been isolated, really still in a cocoon that other sciences broke out of in the 19th century. Academic economics has been influenced still by the thinking of 18th century pre French Revolution, pre-industrial revolutionary thought. And so they create a system in which is self-organizing, self-contained, self-stabilizing, that doesn't exist and can't exist in the real world. And that's a real problem. And I would say, just if I might add, to my Chinese friends, that I've just completed a fairly substantial term as the editor of a journal which concerned itself in part with these issues called Structural Change and Economic Dynamics. Received a lot of papers from China. And I felt disturbed by the fact that Chinese academic economics is caught up in this neoclassical, neoliberal framework. And you can see that if that were to become the dominant view in the Chinese state and Chinese policymaking, it would lead down the same path that has produced rather unfavorable results in the United Kingdom, the United States, and the other countries which have been dominated by this line of thought for a long time.